Cameras are off and participants have been muted, so feel free to use the chat for any questions that come up throughout the presentation. Also joining us today, I believe, I don't see him yet, but I believe Kirk Rondorf, one of the HZCU mortgage loan officers, will be joining us as well today. So we'll keep an eye out for him as he pops on here, and he'll be able to answer questions as well. So that'll be nice. So buying a home involves some major decisions, which can be both exciting and a bit intimidating. But don't worry, this workshop is designed to help you become familiar with the home buying process. You'll learn ways to prepare to apply for a loan, understand the terms of a loan, review the one-time and ongoing costs associated with home ownership, and explore methods to build your personal and financial readiness for home ownership. So let's begin by getting an overview of the topics we'll cover today that will help you to prepare for home ownership. I feel like I've said that a lot, but that's what we're here for today, right? So today we'll cover some important information to help you prepare, such as how lenders may evaluate your loan application, steps you can take to better prepare for getting a loan, and costs associated with homeownership. Specifically, we'll explore the following: how to find out if you're financially ready to own a home, the loan and payment process involved, the costs and responsibilities associated with homeownership, and you should leave today with a greater understanding of how to begin working towards owning a home. Many people are unclear about the benefits and challenges associated with owning a home. So let's take a minute to review some of those. People often don't know whether to keep renting or to buy a home. They wonder, how does buying compare with renting? Will it save me money in the long run? Well, there are some pros and cons to owning a home. Let's review a couple. A home has long-term value. Do you think that's a pro or a con? You need to make payments towards a home, pro or con. You need to pay taxes on a home, pro or con. You can remodel your home any way you like, pro or con. As you can tell, there are many risks and rewards to owning a home. Let's learn more about whether the statements we just discussed are in fact pros or cons. Before we dive in, we'll watch a fun quick video about some reasons people choose to buy or continue to rent. So just a moment here, we'll get our screen share switched over. And this is from our It's a Money Thing financial literacy vendor. Super fun videos. I love it. They're kind of cartoony, but definitely definitely stick with you. So I guess they work, right? All right. So we'll watch this and then we'll continue on.
First-time homebuyer Jen is about to take a tour of 3 potential properties. But first, I want to, excuse me, down here. But first, I want to get a better sense of exactly what my client is looking for. Tell me about your absolute must-haves.
Hardwood floors, and to feel like a real adult making progress in this world, and an open concept living space.
What did you say?
It's when the kitchen like flows into the living room.
No. Before that, you're buying a house just to feel like a grown-up?
Well, it's obviously better than renting, right?
Anyone considering a move needs to understand the pros and cons of renting and homeownership before they make a decision either way.
I'm guessing I won't be touring houses today because Doris found out I didn't do any research before coming on the show.
That's exactly right. Owning a home responsibly has long-term benefits. You don't have to worry about your landlord not renewing your lease. A mortgage can be easier to budget for, too. You don't have much control over increases in monthly rent, but renting does have short-term advantages like mobility. Moving out is simpler. Plus, you can live and work in neighborhoods that would be out of your price range if you were limited to buying.
It's a good point. Owning a home means I couldn't just leave for a new job or something. It would complicate things.
Maybe your family is growing, or maybe you just want that stability. Either way, if you're buying a house, you want to make sure you're sticking around for at least the next 5 years.
But what about the freedom? With my own place, I could finally paint the walls and have as many cats as I want to. Oh, sorry.
As a legal owner, you're not restricted by a rental agreement. The trade-off is that you have to deal with the never-ending cycle of upkeep and repair that comes with maintaining a property. It's a huge responsibility that adds stress and expense. When you rent, your landlord takes responsibility for any major issues.
At least in theory. But why keep paying my landlord when I could be putting money toward my own home instead?
People assume buying a house is a good investment, but the reality is that you can generate value by renting too. You can profit from an increase in property value if and when you resell your house. This doesn't apply to renting. Don't forget that properties can lose value too. Homeowners can choose to rent out their property as a source of income. Again, not applicable to renters, but your living expenses as a renter are simple compared to what ownership costs, which means you can invest the money you'd otherwise sink into your home and grow your wealth that way.
Owning and renting are just different. It's not like one is good and one is bad.
Buying a house doesn't make you a grown-up. Making the right decision for you is a much more grown-up thing to do. Whether you're renting or buying, you can still find your perfect home, sweet home. Or should I say,
Hey.
home, sweet home. Hey, I'll
Hey.
give you some time to think about it.
Stop it.
Maybe we'll end
Hey.
All right, so we will pop back to our screen share here, but as you can see, like they said, no wrong or right answer. So owning versus renting, it's all up to what works for you and how that happens. So I apologize, guys. I'm having a hard time getting back to my Zoom window. I don't know what's going on.
That's always tricky.
I know. Well, normally, I mean, I've done this a few times, but you know, first time for everything. Struggle is real today. All right, there we go. We're heading in the right direction, I think. Okie dokie.
Perfect. Okay. So now we're going to go over some of the pros and cons of owning a home. So what are the pros and cons of the idea that a home has long-term value? So pro of that might be that the value of the home may go up over time, and a con might be that the value of the home may go down over time. Owning a home is an investment in a property, which is a type of asset. Many people assume that they can always sell their home for more money than they paid for it in the future, but it's important to remember that there's no sure way to predict a home's future value. The long-term value of your home can depend on factors beyond your control, such as the real estate market in your area. Anyone who invests in real estate should understand that the risk of a property value may increase or decrease over time. A home is generally considered to be an appreciating asset, meaning its value increases over time. However, it's important to understand that there's no guarantee that you'll make a profit when you decide if you're going to sell your home in the future. It isn't as simple as selling your home for a higher price than you bought it for. If you spent money on repairs, maintenance, and renovations, you may not be able to earn that money back, so to speak, by selling your home for a higher price. Not all renovations increase a home's value. So whether or not to invest in real estate by purchasing a home is really a personal decision that can depend on a variety of factors in your life. It can help to think of home ownership as investing in a place for yourself and your family and investing in a community, but not necessarily investing in an asset that you can sell for a large profit in the future. What are the pros and cons of the idea that you need to make payments towards the house? Pro is that a portion of every monthly payment goes towards the principal, meaning the amount you borrowed from the lender, and it gets closer to fully owning a valuable asset. But a con may be that you need to make a large down payment up front, and there may be other one-time and ongoing home ownership costs. What are the pros and cons of the idea that you need to pay taxes on a home? A pro is that homeowners may be able to deduct mortgage interest and property taxes on their income tax return. And a con would be that you must pay property taxes, which you wouldn't be responsible for as a renter. What are the pros and cons of the idea that you can't remodel your home? You can remodel your home any way that you like. A pro is that you can renovate and decorate your home according to your tastes. And a con would be that you're responsible for all repair and maintenance costs. Have you thought about home ownership pros and cons before? Knowing the pros and cons of home ownership helps you to have a realistic approach and know what to expect as you move forward with home ownership. Whether buying your first home is months or years away, there are things you can do now to prepare yourself for the process. Okay, Most people cannot afford to purchase a home without getting a mortgage, which is a loan for the purpose of buying a home. A way to prepare for home buying is to understand what lenders are looking for in a borrower. The key question to ask yourself is, how can I prepare to get the most favorable loan possible? Understanding terms is an important part of preparedness because you'll hear these terms often from lenders and others in the home buying process and see them on loan applications. Let's begin by exploring some common terms and why they're so important in the home buying process. Why are income and income history important to a lender? Income and income history information, income and income history information for a lender will let us know whether the borrower has resources available to repay the mortgage loan. What is a debt to income ratio? I'm sure we've all heard of that, but a debt to income ratio, or a DTI, is a percentage that tells lenders how much of a person's monthly income before taxes goes towards debt payments. Lenders prefer to loan money to people whose expenses are less than 43% of their monthly income. Now, why are credit scores important to a lender? A credit score reveals to a lender whether a person repays his or her debts on time. A very good or exceptional credit score can indicate to a lender that you'd be less risky to loan money to. You may qualify for a more favorable loan term as a result. Why is a down payment important to lenders? A down payment is generally a lump sum of cash that you use to pay for part of your home purchase. Having enough cash for a down payment shows lenders that you're committed to the purchase and that you will likely repay the loan. Having savings also shows a lender that you have a safety net in case of emergencies or unforeseen circumstances. The top 3 reasons that people default on loans, which means they're unable to make payments, are family changes, for example, a new baby, elder care, causing expenses to increase, or an accident, which requires medical attention or time off work. And then that also causes your expenses to increase and possibly your income to decrease, or a change in job status, which would cause your income to decrease. Lenders prefer candidates who are low risk, meaning those who are well prepared to pay their mortgage even if their present circumstances change. A borrower who has steady income, savings, a good credit score, and a good DTI is typically considered low risk, and thus probably more likely to pay his or her mortgage on time. On the other hand, a person without a steady income or job, or with little savings, poor credit, or a high DTI may be more likely to default on a loan and thus may be considered a higher risk. Being a good candidate for a loan is one of the factors that determines the amount of money and the interest rate that you receive. It's important to try to be the best possible candidate. Let's look at a strategy to prepare ourselves to be a good candidate for a loan. The 5 C's of credit. So in general, lenders use 5 criteria to determine credit worthiness, and these are sometimes called the 5 C's of credit. Knowing them can help you to prepare to become a good candidate for a loan. Lenders use the 5 C's to find out a few things about you. Capacity is your ability to pay your bills now and in the future. If you have a steady job or a profitable business, lenders will see that you should be able to pay your bills. Capital is readily available money and savings, plus investments, properties, and other assets that you could sell fairly quickly for cash to pay back a loan. Assets are any items that have significant monetary value. Collateral is property or other possessions of value that you could put up as security against your loan. Character is your history of delivering on commitments. If you make your payments on time, you will be considered a low-risk borrower. Conditions are the purpose of a loan and any factors that may affect your ability to repay. How could you show your capacity to pay bills now and in the future? Some examples of that would be your employment history, current pay stubs, or earnings from a business. What are some examples of capital that a person could have? Cash, savings, investments, valuables, property. What types of collateral could a person offer to secure a loan? Maybe a car, motorbike, land, other homes, or other valuable items. For a mortgage, the home you borrow money and purchase is the collateral on that loan. How could you demonstrate character to a lender? Establish a history of making on-time payments of your debts and bills. How can conditions affect you? How can conditions affect how a lender views your mortgage application? The fact that the specific purpose of a mortgage is to buy a home, this may reflect more positively on you than if you sought a more general loan that could be used for any purpose. The lender will also consider a variety of factors in your life that could affect your ability to repay. Another step to help prepare for home ownership is to have an accurate picture of your current financial situation. Looking at 2 of the 5 C's, capital and collateral, can help you to assess your financial situation. How much capital do you have access to, and how does it affect the home buying process? What is collateral, and how can it help you in buying the home buying process? Capital refers to cash, savings, or any assets that you own that has significant value, like a car, real estate, investments, or jewelry that you could sell quickly for cash. To determine your personal capital, you could list all the items you own and their approximate value. Knowing the value of your items is important because it shows lenders that you have assets with cash value that could be applied to loan payments if needed. Collateral is basically an asset that the lender could use as security in exchange for giving you a loan. Like we mentioned, your home would be collateral for a mortgage. That means if you're unable to afford your mortgage payments for a period of time, the lender may take your home, foreclosure. If you have little credit history, lenders may feel more comfortable giving you a loan if you have some type of collateral to secure it. Now that you have a basic understanding of some important terms and how your assets or capital play a role, let's discuss how you can assess how ready you are to buy a home. In this activity, you will get an idea about the steps you may need to take to prepare for buying a home. One common estimate is that you may be able to afford a home is that the home should be about 2 or 3 times your annual household income. Another way to estimate is the total of your monthly gross household income, which is your income before taxes. Aim to have your monthly housing costs equal and no greater than 28% of your monthly income. To find out the price of a home you can afford, you'll need to know your income, amount of debt, and spending and saving habits. Now, let's understand why these items are important. So step 1, know your income and assets. Let's start with your income. Knowing how much money you currently have and how much you currently spend will help you get an idea of what you could afford to spend on a home and the related costs. Ask yourself, do I have a steady monthly income? Do I anticipate a change in my household income in the near future? Changes could include risk of job loss or dropping from 2 incomes to 1 if your spouse stops working. A common requirement for a mortgage is to have a stable income for at least 2 years. If this does not describe your current situation, that's okay. You can still prepare for homeownership by knowing this and planning ahead for the next 2 years. Add up the value of any assets you have, such as your home, car, jewelry, and investments. If you don't have a long credit history or you have bad credit, these assets may be used as collateral to secure a loan. Ask yourself, what is the sum total of my assets? Step 2 is to know your expenses, payment history, and debt payments. Expenses include things that you must pay for each month, such as electricity, food, rent, transportation, and so on. How might these expenses change if you buy a home? Changes could include higher or lower utility costs or higher or lower commuting costs. Payment history helps lenders calculate your readiness to buy a home. Starting today, you can develop a good system to pay your bills on time. It's a great way to prepare to apply for a mortgage, as it will help to increase your credit score and possibly qualify you for a more favorable mortgage term. Ask yourself, what is my payment history? Do I pay my bills on time? How much debt do I currently have? Debt includes any money that you owe, including credit cards, loans, and so on. Do I make on-time payments each month? And do I make at least the minimum required payment for each of my debts? What is my credit score? And then the last step is know your savings habits. Saving money means putting money aside for emergencies, upcoming expenses, or longer-term goals. Savings are important for homeowners because we must pay for unexpected home repairs. Do you have money left over after your expenses each month? Do you know how much you set aside as savings each month? Do you have a savings account or another method for saving? It's okay if you don't know the exact numbers right now. These questions may be a little difficult to answer, but it is important to know exactly how much money you make each month, what you spend the money on, and how much you save. Home ownership is a big financial commitment. As you consider buying a home, whether it's in the next few months or several years from now, it helps to develop an action plan for your spending and savings.
All right, so by using your spending and savings action plans, you'll be better able to see and evaluate how you spend and save your money. These tools will help you to see areas where you can cut costs and where you can save money for things you really want. Since a home purchase involves many upfront costs as well as ongoing costs for maintenance and repairs, it's important to evaluate your current spending and to make room in your budget to build a savings reserve for home expenses. Right now, let's meet Christina and look at part of her spending action plan. Christina is a single mother with a 10-year-old. She currently works 2 jobs. She created a spending action plan that includes her current expenses and what she regularly spends her money on. Christina's spending action plan has 2 sets of expenses, needs and wants. Needs. In this section, Christina used the itemized sheet to write down necessities she pays for each month and how much they cost. In the wants section, Christina wrote down what else she spends money on or spent money on this month and how much each item cost. You can track these for yourself as well. How much would Christina have saved this month? What could she have done? What could she have cut back on to increase her savings? Are there exceptions to spending on some of the wants listed on the worksheet? What would they be? Now that you've seen Christina's spending action plan, let's look at how you can start one for yourself. You can use a worksheet to plan your financial future. Having a list of things you spend money on is helpful in 2 ways. First, you can track your spending. It can show you areas where you could save. Reducing spending on even small items can add up to big savings over time. Identifying exactly where your money goes each month can be a powerful exercise. Cutting or lowering some of your expenses can free up money to set aside for a down payment, future mortgage payment, or other home-related expenses. This can even help you save for a big goal even faster. You can track what you learn the second way here. It can give you a clear picture of the following: what kind of house you can afford, what kind of down payment, if any, that you can afford, and how well prepared you are to handle the extra costs associated with home ownership. If you'll turn to page 4 of your participant guide, there is a page in there called Creating a Spending Action Plan. It's a good idea to make one of these, like Christina's, with your family members. It helps when everyone understands the goal and works towards it together. Now, let's talk about turning that spending plan into a savings plan. Whether you need money for the down payment, closing costs, or incidental expenses associated with owning a home, it's smart to start saving now to put yourself in the strongest financial situation possible. So, what does your current savings system look like? Many people don't think about saving on a regular basis, unfortunately. A savings plan can help you to do the following: set goals by determining what you would like to buy and how much you will need to save for it. Adjust your current spending habits to accommodate your future wants and needs. Evaluating and making changes to your spending and savings habits is an important step to take as you assess your readiness for home buying and prepare for owning a home. Now that you have an idea of what financial readiness means, let's discuss 2 major factors that can affect how qualified you are for a mortgage. Another of the 5 C's that we talked about earlier is capacity. So capacity is your present and future ability to meet your payment obligations. One of the calculations lenders use to determine this and your loan worthiness is that DTI. Lenders use the DTI to predict whether a borrower is capable of making a new mortgage payment. The DTI is calculated in this way. You'll divide your total monthly debt payments by your total monthly income before taxes or deductions. Multiply that number by 100, and the result will be a percentage, which is your DTI. In general, the lower your DTI, the better your balance between debt and income. And the more money you'll likely be approved to borrow for a home. Let's meet Marta and see what her DTI is. So Marta's paying off her student loan and car loan while also trying to pay down some of her credit card debt. In this activity, we'll learn how to calculate a debt to income ratio. So this may be old hat for some of you folks. I know if you are credit union people, but just bear with us here. So step one, we'll add up Marta's expenses, calculate the total monthly debt, and by adding up all of her debt payments. And then Marta's total monthly debt payment is $600 plus $400 plus $700. So $1,700 total there. In step two, we're going to calculate her DTI. So DTI equals total monthly debt payments divided by total monthly income. We know her gross monthly income is $4,000. To calculate her debt to income ratio, we divide her total monthly debt, or $1,700, by her total monthly income, $4,000, and the result is 0.425, which is 42.5%. So another way of describing DTI is that her debt is 42.5% of her income. To qualify for a mortgage from a financial institution, your DTI must often be at least 43% or lower. Borrowers with higher DTI percentages may have more trouble making payments, at least in lenders' eyes. Will Marta's DTI of 42.5% make her more or less likely to get a loan? Although it's not the only factor that lenders consider, her DTI of 42.5% is below the recommended value of 43%, so she may be a good candidate for a mortgage loan. Your credit score reflects how responsibly you have paid bills or debts in the past. Your credit score can have one of the biggest effects on your financial life, including the mortgages that you'll qualify for. Lenders consider your credit score when determining whether to approve a loan and the amount of the loan. What is a credit score and why do you need to know yours? Well, again, this may be old hat for some folks here, credit union folks, but there are ways to improve your credit score as well. Credit scores represent your credit report. They're used by companies and financial institutions to assess your risk, the likelihood that you will not or will pay back your debts. There are many types of credit scores, such as credit scoring models, such as FICO and Vantage score, which generally range from about 300 to 850. A low number typically means that a person is considered high risk, and a high number typically means the opposite. Those are low risk borrowers. Credit scores are determined by looking at the information reported by the three major credit bureaus, Equifax, Experian, and TransUnion. Higher credit scores may help you to get a better mortgage interest rate. So request your credit report and review it for accuracy before applying for a mortgage. Take any necessary steps to start improving your credit score now. Again, maybe you're not ready for the home buying process, but definitely can work towards it. So you want to make those on-time bill and debt payments. That will definitely help to improve your score. And then the Fair Credit Reporting Act, or FCRA, allows you to receive one free copy of your credit report each year from each of the nationwide credit reporting agencies. So all three of those bureaus. You can go to annualcreditreport.com to request your report today. A low credit score number signals a high risk and a high number signals a low risk, right? We've mentioned that before. So use your available credit wisely. Use less than 30% of your available credit each month, and do not max out your credit cards. Pay your bills on time. Can't stress that one enough. If you can, pay your bills in full each month, because lowering the amount that you owe is a big factor in your credit score. Paying off your loans on time. Defaulting on your debt, meaning that you pay your loans on time, that's good, but defaulting on your debt, meaning that you stop making payments, will cost you in fees and definitely damage your credit score. Limit credit applications. That's another great thing to mention with the mortgage loan process. If you have gotten pre-approved and are looking for homes, you're at that step, don't apply for a new credit. Hopefully your lender is going to tell you that too, but in case they don't, I'm doing it now. But in general too, applying for too many credit cards or loans in a short period of time can lower your credit score. It's going to signal that you might be in trouble typically. If you plan to apply for a mortgage in the next 6 to 12 months, you may want to avoid applying for that new credit altogether, like I said. We've learned many ways to help assess your financial situation and to help you better understand how you'll be evaluated by the lenders. Now, let's take a look at the costs associated with home buying.
Understanding other costs associated with home buying can help you to be better prepared to make all the necessary payments in a responsible way. Commonly discussed home buying expenses include down payments, mortgage payments, interest payments, and insurance. But there are other costs to consider that may not be that well known. They include costs such as earnest money, closing costs, inspection costs, and appraisal costs, to name a few.
Oh, I'll never forget that earnest money one when I bought my house. I was like, what? You want more?
Surprise.
Oh my gosh.
Yes. So let's first look at all the costs associated with the purchase price of a home. Most buyers take out a loan in order to afford a home purchase, but there are still some upfront costs to pay as well. A down payment is an initial payment towards the purchase price of a home and is typically between 3 and 20% of the purchase price. Your savings, loan size, and credit score will determine the actual amount. In general, the larger your down payment, the lower your monthly mortgage payments may be. Let's take a look at two scenarios. Do you think it is possible to purchase a home without a large down payment? Yes, but it's more expensive. While some home buyers qualify to buy a home without a down payment, most people will put some money down at purchase. The more money that you're able to put down, the lower your monthly mortgage payments and interest rate may be. You may qualify for low down payment mortgages through government guarantee programs such as the Federal Housing Administration, U.S. Department of Agriculture, and Department of Veteran Affairs. We'll talk more about those shortly. What does having a down payment indicate to a financial institution? Lower risk. Financial institutions tend to recognize buyers with down payments as being better prepared to buy a home and less of a risk. Because buyers with a down payment are investing in some of their own money, they are borrowing less than the full purchase price from a financial institution. Lenders can thus offer borrowers better terms on their loans. In addition, scenario B shows how saving money for a down payment may reduce your costs. In this case, the amount of interest owed. Marta will save $1,200 each year as a result. The interest rate is often lower when a buyer makes a down payment because it reduces the total amount they owe the lender and makes the loan less risky. Saving money for a down payment can help you to get a lower interest rate and require you to pay less interest over time. It can also help you to avoid purchasing private mortgage insurance, which is an additional expense that we'll discuss a bit later. In addition to your down payment and monthly mortgage payment, there are many other expenses associated with the home buying process. When you're buying a home, you generally pay all of the costs associated with that transaction. However, depending on the contract or state law, the seller may end up paying for some of those costs. As we know, lenders check your credit score, and there's a fee associated with that. Buyers usually are responsible for paying that fee, which ranges from $20 to $50. Now, earnest money, as Jen was mentioning. So earnest money is an upfront cost that later gets applied to other fees. Although your state may have laws on this topic, generally when a buyer makes an offer on a house and the seller accepts the offer, the buyer pays earnest money to the seller as an indicator that the buyer is serious or in earnest about purchasing the home. Earnest money usually is refundable based on the inspection, loan, and other factors. Thus, if a loan falls through or the home does not pass inspection, a buyer can get the earnest money back. When the home closes, the previously paid earnest money should be put towards the closing costs. It's normally approximately 1 to 3% of the purchase price and an indicator of good faith. Hiring the independent inspector to assess the home's issues or maintenance needs is highly recommended. Buyers are responsible for the cost of the inspector, but the seller may agree to pay to repair any identified problems, or as an alternative, they may reduce the purchase price to compensate. The inspector provides a detailed report of all aspects of the house, including the quality of the roof, plumbing, appliances, gutters, and so on. Inspection costs can depend on the size of the house, and repairs are often noted in the inspector's report. Usually the seller will agree to fix any problems, but sometimes the buyer will be responsible. Appraisals often are requested by lenders to ensure that the value of the home is indeed what the seller claims it to be. The buyer may be able to negotiate these fees and have the seller pay them. Maintaining your home can cost between 1% and 4% of the home's value each year. This can include expenses like hiring pool and yard maintenance services and making repairs as needed or even updating appliances. You may also take on more expensive projects like replacing a roof or renovating the kitchen, which makes some years' maintenance costs higher. Closing costs are another upfront cost to purchasing a home. Since this is a large expense to save up for, it's helpful to understand what expenses make up your closing costs.
Closing costs are expenses over and above the purchase price of a home. They're paid at the end of the home buying process when the deal is closing and when, in many states, the title of the house gets transferred from the seller to the buyer. Closing costs may include, but are not limited to, the following: appraisal fees, tax service provider fees, title insurance, government taxes, prepaid expenses such as property taxes, homeowners insurance if applicable, and interest until your first payment is due. However, you may be able to negotiate or bargain so that the seller pays some of these costs as well. The total amount of closing costs may be between 2 and 5% of the purchase price of the home, but it can depend on where the property is being sold and the value of the property. So check your state laws to learn more about the fees and charges you may be responsible for as a buyer. Now that you know more about the closing costs, let's look at insurance costs that you may need to be accountable for. And one thing too that I want to mention, I know it sounds, when we're saying like 2%, 3%, 4%, you're like, oh, it's not that much. But when you're talking about the purchase price of a home, it's going to be hundreds of thousands of dollars. Don't let those little percentages fool you guys. Just keep that in mind. So if you're unable to make a down payment, that is at least 20% of the home's price, you may need to purchase private mortgage insurance, or PMI. This requirement varies by lender, but we'll cover the basics here. So a buyer purchases private mortgage insurance to ensure that the lender will be paid the amount of the outstanding mortgage in the event that the buyer defaults or is unable to pay. Or in case the buyer passes away also. I did not know that until here, but yes, that also applies for private mortgage insurance before the end of the mortgage term. So if they pass away or if they are not able to make their payments anymore, it's when that PMI steps in. The cost you pay for PMI varies depending on the size of a down payment and the size of your loan. PMI protects the lender, not you, if you stop making payments on your loan. Buyers who are able to make a down payment equal to at least 20% of the home purchase price often can avoid paying PMI altogether. Why would a lender require mortgage insurance? Well, mortgage insurance lowers the buyer's risk to the lender, enabling buyers to qualify for a loan for which they might not otherwise qualify for. Keep in mind, the cost of insurance will be added to your monthly mortgage payment. It costs about $30 to $70 per month for each $100,000 that you borrow. Once you have the 20% equity in your home, meaning that you owe 80% or less of what you originally borrowed, you may be able to cancel your PMI and reduce your monthly payment at that point. The mortgage insurance discussed thus far is associated with conventional loans that you may receive from a bank or credit union. But there are other types of loans available, so we'll take a quick look at those two here. Most of the time when we think about a mortgage, we think about a conventional loan. 15, 30-year mortgage, those kind of things. But there are non-conventional loans too. So let's find out what they are and the differences between these conventional and non-conventional loans. So like we said, conventional loans are typically offered by many lenders. Requirements are going to vary based on the lender and your credit worthiness, including that credit score and DTI. Non-conventional loans are government-backed loans that are available to buyers who may not have good credit history or enough money for a down payment. Some examples of these would include the following: FHA insured loans. The FHA insures loans so that eligible borrowers can get better deals through private lenders. Or USDA loans. VA loans is another example. Although non-conventional loans help people who otherwise wouldn't be able to buy a home, there is a limit to the amount of money that can be borrowed, and insurance rates on some loans, such as those offered by FHA, USDA, or VA, tend to be high. So FHA insured loans. So the FHA can help to insure your loan, so it's easier to get a loan through a private lender, such as a bank or mortgage company. VA loans, those insured by the VA, for eligible veterans, service members, and surviving spouses, the VA can guarantee a portion of the loan from a private lender. And then finally, USDA Rural Development Services Loan Assistance. So that was a mouthful, but that's for those that are looking to buy a home in a rural area. The USDA offers several types of loan assistance for direct loans and guaranteed loan programs. USDA assistance programs typically are targeted to low and moderate income individuals. Horizon Credit Union offers conventional loans and all three types of those non-conventional loans as well, plus more. Be sure to research the mortgage insurance that is associated with your specific type of loan. And now that you know more about different types of loans and what common home buying expenses to budget for, let's address a question that most of you probably had at the very beginning of this workshop. How much house can I afford? Well, before applying for a mortgage, you should know approximately how much you can afford. That's a good thing, right? I know a lot of people are like, I'm just going to go get approved for as much as they'll give me. Well, not the best idea. So let's use a tool to estimate home affordability. Although lenders ultimately will determine the size of a loan which you qualify for, in the end, they will, but you can still get a good idea of your affordability range, and make sure that you can make those payments. Because like I said, they may give you the maximum amount and you're like, whoa, can't afford that, really low in my budget. So this number can help inform your home search. One estimate is that borrowers typically can afford a mortgage that equals 2 to 3 times their annual household income. The amount of money you are able to provide as a down payment plus the amount of your mortgage can give you a sense of the total cost of a home that you can afford. Step one here would be to figure out how much you think you can afford for a down payment. Write down that number. Step two is going to be to decide how much you earn per year. And then step three is to multiply your yearly earnings by number 2. So write down that number. And then step 4, multiply your yearly earnings by 3. Write down that number. So a couple different options there. And you can also use the 28% of monthly income rule. So step 1 with this one is to decide how much, first write down how much you earn per month before taxes, divide your annual income by 12 monthly, right? Step 2, multiply this number by 0.28, write down that number. This is how much you can afford to pay per month in housing costs. So did this activity result in any amount you expected? And please know you can always just jot down that little simple formula and do that later. Well, you want to approach home buying from a knowledgeable and informed perspective. Notice that we said that was your total monthly housing costs. So that is got to include those insurance, the PMI insurance if you have it, that kind of thing, home buyer's insurance though. So just factor that all in. And then knowing the results from this activity can help you refine your future housing search. It's important to remember that these calculations though are just rules of thumb. Your situation is going to vary and it will be helpful to definitely team up with a financial expert, mortgage expert to determine your home buying budget. With the knowledge you have gained today, you should be better able to assess whether home buying is the right choice for you or not.
As you evaluate your personal and financial readiness for homeownership, know that you are not alone. There are resources available to help you plan and understand the home buying process. If you turn to page 9, free resources of your participant guide. In addition to Horizon, there are laws and organizations that protect consumers when buying a home. Use government resources such as the Consumer Financial Protection Bureau at consumerfinance.gov and the U.S. Department of Housing and Urban Development at www.hud.gov to access tools and information on the latest policies. These resources also offer a step-by-step procedure for all the aspects of home buying, from shopping for a home to closing a deal. There are many resources available to help you fully understand all aspects of homeownership. If you feel confused or uncertain, you can contact one of the government agencies listed to walk you through the process. We've learned that, go ahead, sorry.
I had to jump in. I said, or your friendly lender.
Yeah.
Something that you have to trust when you're buying a home, make sure you have a great lender and a great relationship with them that you can call, ask questions, that kind of thing. So important.
Yes, definitely.
Sorry.
No, you're fine. We've learned that while some factors like home prices are beyond your control, other factors are within your control to help you prepare for homeownership. And as you can see, many aspects of buying a home are interconnected. Generally, the better your credit score, the better the interest rate you can secure. The larger the down payment you make, the less costs you may incur. Home ownership will be within your reach if you do the necessary prep work needed to save for upfront costs and to qualify for a loan. Use each section of the participant guide to help guide you through the process, from listing your spending and savings to finding your credit score and calculating your DTI to understand mortgage insurance and home ownership costs. Ultimately, you will be able to check off all the boxes in that assessing homebuyer readiness checklist and be on your way to getting your dream home. You have learned to determine your financial readiness for home buying by using a variety of tools, spending and savings action plans, DTI, and credit score. In addition, you've begun to grow your knowledge of the types of closing costs, how lenders assess risk, the pros and cons of home ownership, and appreciating and depreciating assets. Deciding to buy a home is a big step, but it doesn't have to be intimidating. Knowing the right questions to ask and the steps to take to get started will help you make the decision that is best for you. Does anybody have any questions? You can feel free to drop them in the chat if you do. Tell me if you see anything pop up, Jen.
Not seen anything so far, and I don't think that Kirk joined us, so unfortunately he will
Okay.
not help out with questions at this point.
Okay.
But-
Yes, but so you guys can feel free to reach out to a mortgage loan officer here at Horizon with any specific questions to your circumstances. Thank you for joining us, and remember, your journey is unique to you. You can continue your financial journey at the Financial Training Ground on HZCU.org. Explore a variety of topics, including interactive guides at the top link shown, or create a personalized financial education playlist from the bottom link.